Hi there, Jeff Lerner, CEO and founder of Entre Institute. We're an entrepreneurial education company that's interested in all things business and entrepreneurship. I believe that entrepreneurship is the best way in the modern world to create an amazing life for most people, and our company passionately reflects that belief. Obviously, with the GameStop craziness in the media lately, I thought I would take a minute and talk about it through an objective business lens. I don't have a dog in the fight. I simply think it's important to take any opportunity to have rational conversations around business and value and economics. I think these are the forces that create really give us the most opportunity to create the most upward lift in the world for everyone. These are the levers we need to pull, and we need to be pulling them intelligently. And the more we can inform the world about how these levers work, the more people we can empower to use them to their benefit. So let's use this opportunity, or use this situation as an opportunity for teaching and for hopefully logical and reasonable discussion. All right, first of all, let's talk about the players involved. And I'll say this, if you don't know what I'm talking about the GameStop Reddit thing, just a quick Google search will bring you up to speed. So the players in this craziness, first of all, Wall Street short sellers. These are hedge funds and other traders that are betting on GameStop, the stock of GameStop, to go down. Probably an important guiding concept is to realize that the stock value of a company has nothing to do with the operations of the company in real life. I mean, GameStop is not going to be affected by this for the most part, except certainly by the stock going up. If the stock price were to go way down below what it was before all the craziness happened, that might impact their credit facilities or borrowing power, because the underlying value of any stock that they had pledged as collateral, or investors, investors' stake in the company might decrease in value. But the fact that it was artificially run up and then back down, or hasn't gone back down yet, but as you'll see, I'm proposing that it will, that really doesn't impact GameStop day to day. It's more the people that are speculating and betting on the share price of GameStop. And so there's this group of what are called short sellers, which I'll talk about what a short sell is, that are betting that the price is going to go down. And then you have this group of people on the social media site, or social, I guess Reddit's technically social media. It's a discussion site where people get in these threads and have these conversations. And Reddit tends to have kind of a little bit of I guess you'd call it almost a radical element. A lot of normal conversations are had, but it's a little bit of a breeding ground for these sort of radical ideas sometimes. Crazy things often happen in conjunction with Reddit. Then you have GameStop itself, which is frankly a pretty shaky retail company that's been losing a lot of value in its stock price. Again, it's not because of what's happening day to day with the company. It's because of the market's projection of the long-term value of the company, which is all the stock price is it reflects the market's best guess as to the long-term value of the company and what its long-term profits are going to be. The stock price theoretically reflects the value of all the shares accumulated. Theoretically reflects what's called the best guess of the net present value of the company, which is simply the discounted value of all predicted future cash flow. So if they think a company is going to make a lot of money in the future, the value of the company will go up, and the stock price will naturally sort of adjust so that the accumulated value of all the shares roughly equals the value of what people think the future cash flows is going to be. And if they think the profits are going to go down, or that there's not going to be positive cash flows in the future, then the value will decline accordingly. But it's not a perfectly rational system. In fact, it's often a very irrational system, because everybody's just trying to make money or not lose money. There's actually very few investors that are solely focused on the value of the company itself, and that actually know how to do the math and have the information to really forecast that. Everybody else is kind of guessing, and they're either trying to not lose money or make money. And even the rational investors, they know that the market's not rational, so their rationality only has so much value. And then in fact, they're also having to work against the fear and greed fluctuations in the market. And that's why historically over time, the investors that win are the very rational investors that are also willing to play the very long game, so that the volatility of the ebbs and flows of fear and greed can kind of wash out over time. But anyway, that's another conversation. The reality for GameStop is a brick and mortar company that sells games. Gaming sales are obviously migrating online with like services like Stream. And also the pandemic has really discouraged in-store shopping of all kinds. GameStop has had major problem over the last several years. And then you have these trading apps this main one is called Robinhood. There's other ones that are a little bit lower quality in terms of like their features and their research tools. And they're not really used by very sophisticated investors. Like, for example, I would not trade through Robinhood. I use E-Trade. A lot of people like them because they have no commissions. And, I would say, well, you kind of get what you pay for. But they've given access to a broader set of the public that maybe wouldn't qualify for account minimums or don't want to pay the fees associated with some of the higher end trading platforms. But, as I think we'll see, the flip side of that is they're maybe a little more, since they're less sophisticated and they also don't have access to the same information, they're maybe a little easier to rile up or, get to do things for emotional reasons. And then you have market regulators, like the people that, in this case, intervened after the fact, to the people who are in charge of, and that's market regulators aren't just Securities and Exchange Commission. It's also like power players, people that have enough money that they're substantively important to the broader economy. And they kind of have with that some direct and some implied sort of powers or a voice that not everybody has. And that a lot of people don't think that's fair. And I very often would agree that it's not. I don't think the paradigm of people that have influence over billions of dollars, that they shouldn't have maybe a significant voice in the economic conversation. But I think that it shouldn't happen in a lot of the ways that it happens. But again, I'm trying to stay really neutral and stay out of the politics of all this. But let me just say, I guess to declare for the record that I don't have a specific viewpoint on this. I have what I hope is a very logical, forecast about how this is going to play out. But I guess it'll be obvious, so I might as well say I do have an underlying belief in the importance of the capital markets, capitalism in general, when it's allowed to operate freely and it's not abused by people at any level, top, bottom, middle, left, right, whatever. But in this case, some very important people did start to intervene. They're actually still intervening as I say this, to try to limit not so much the losses, but the chaos and the long-term implications of trying to destabilize the market, which is a little bit of the dynamic here. So let's have a quick conversation about what happened. First of all, this is a short version. Again, if you want the long story, there's a zillion articles out there you can read. But in a nutshell, GameStop shares had already fallen 80% in the last 3 years. I think 3 years ago it was at 30 or 40, and now it was down around, let's say, hovering between 5 and 10. And that was just the natural reflection. That wasn't even because of COVID or the pandemic. That was just what's happening to all brick and mortar retail as stuff moves online. They have this overhead, they have these leases and this inventory and higher costs and lower revenues. The Wall Street hedge funds, a few in particular, but generally the consensus on the market was that GameStop's stock is going to continue to decline. And so there's a way that you can predict that you can benefit from that. You can profit from a stock going down, what's called shorting. And you can actually profit even more if you short with leverage, which I'm not going to get into a ton in this conversation, but just know there's a way that if the price goes down $1, you can make $2 or $5 or $10. But the flip side is true. If you're wrong and the stock goes up $1, then you lose $2 or $5 or $10. So you have a multiplier factor in your investment if you use leverage. Again, not the point of this conversation, but it is significant to know that Wall Street has a way to disproportionately benefit and or suffer from price changes that is different than what the average retail investor typically knows how to do or has access to. That does kind of start to matter here in a little bit. But for now, just know the Wall Street hedge funds are betting the price is going to go down, so they are shorting the stock. So let me real quick explain what a stock short is. Basically, it means that an investor, you don't go buy the stock. What you do is you borrow the stock, and you have to pay it back by a certain date, typically with a little bit of a premium. Obviously, you borrow something and pay it back. Maybe you're paying some interest, or maybe there's a flat fee. But you're borrowing the stock because you think is going to go down. And you have to repay the stock. You have to actually deliver back the stock shares by a certain date. And again, you pay a fee, some sort of a fee or premium in the meantime for that privilege. Then what you do is you go sell those shares on the open market at the current price. So if I buy let's say 100 shares of, or not bad, if I borrow 100 shares of GameStop at $5, then, and let's say I have a month, I might pay, that'd be $500 worth. I might pay like $5 for the privilege, like a 1% premium or something. Now I have a month to give those 100 shares back. I'm now waiting for the price to drop, and hopefully it does so within that month, because that's my deadline to repay the stock. And so then let's say the price goes from 5 to 2. I then, within that month, I can then go spend $200. Remember, I got paid $500 when I sold the stock that I borrowed. I can go spend $200 to buy the stock on the market, because now it's down to 2 and I'm buying the 100 shares so that I can give them back to the lender, pay off the loan by giving the stock back. And remember, I sold it for $500. I bought the underlying asset for $200, delivered it back to the lender, plus I had to pay a $5 premium. So that still gives me $295 in profit. And even if you didn't follow those numbers, just understand it's basically you're borrowing something that you can sell at the current price. You're waiting for the price to drop so that you can actually buy it at the new lower price to pay it back and keep the difference. And that's, I just wrote that here. The investor returns the borrowed shares to the lender and keeps the difference in price times the number of shares. Okay, so it's how you make money when you think stock's going to go down. So now let's go back to what happened. We left off here that the Wall Street hedge funds had shorted the stock, and they now have until X date to buy back the stock and return the borrowed shares. And X date varies depending on the short contract, right? So every investor, every position in the stock, every short position has its own terms. It can have its own fees, can have its own repayment dates. But as that date approaches, investors can be squeezed out if the price has risen instead of fallen, or even simply it hasn't gone down, because they have to buy the share. Well, I guess to be squeezed out, you need the price to go up. If it doesn't go up or down, then you just break even and you lose the fee. But you basically have to buy the stock back by the contract date and give it back. And so if the price has gone up, you're going to end up paying more than what you got paid for them, and you're actually going to eat the difference rather than gaining the difference, right? And so what happened is in this Reddit thread called Wall Street Bets, they came up with this plan. Hey, we know there's a bunch of big short positions on Wall Street. Let's all get together as retail investors, which just means individual investors, you and me, for example, at least me. I don't know who you are, but and we'll go on our E-Trade account or our Scottrade account, or in particular on this, it was a lot of users of Robinhood and these kind of lower end trading platforms, because they're more apt to be caught up in a buying frenzy from a Reddit thread. Let's face it, like sophisticated investors aren't doing this stuff, right? And so they go, let's all get together, and when there's more buy orders than sell orders, the price goes up. So let's all buy, and we'll drive the price up, and we'll squeeze out these Wall Street guys, and we'll show them, right? That happens. That starts to happen. The investors do get squeezed out. And then ultimately these power players I talked about did kind of step in to say, hey, let's limit trading and blah, blah, blah. And that's a lot of what people are kind of worked up about now. But the bottom line is it worked. The Reddit buyers drove the price of GameStop from $20 to over $400 in about 2 weeks. And then the short sellers were forced to cover their position, because essentially when the price gets beyond a certain point in the wrong direction for them, it triggers alerts, and whether it's through their institutional trading policies or the policies of their creditors or the policies of the short contract itself, there's a point where they have to buy it back, they have to take the loss, and they did so. And so far, Wall Street has lost approximately $20 billion. I heard that a hedge fund went out of business. And there's a pretty important principle here. I didn't make a slide about it, but it bears mentioning that there's something called the float, which is the number of shares that are trading in a stock at any given time. So just because there's a million shares of a stock doesn't mean that a million shares are trading. You might have 900,000 of those shares that are owned by a retirement fund, a pension fund, the police workers union fund, and they don't do a lot of trading. And those 900,000 are not actively trading. And so, it's only the 100,000 that determine the value of the 900,000, because the 100,000 is where the supply and demand economics are working out to determine the price based on number of buyer interest versus number of seller interest. The more buyers, the more price. The more sellers, the lower price, right? That's just market supply and demand. So in the case of the Reddit deal, I don't know how many shares outstanding GameStop had. Most of these institutional investors, until they get short squeezed, they're not trading the stock, right? And so out of all of these shares, especially once there's this anomalous behavior happening in the price, sophisticated investors are going to stay out of it. They're certainly not going to try to get in on trading it. The short positions are already in place. You basically have a very small number of shares relative to the total outstanding shares. The float on this is relatively small, and it's just Redditors trading shares back and forth to each other, right? Presumably. I mean, that's a little bit of an oversimplification. So because you have a lot of sudden supply and demand change on a float that's a relatively small percentage of the total outstanding shares of the stock, it has a very disproportionate and unnatural effect on the price. In other words, if there's 1,000 candy bars in a school, but 998 of the kids already have their candy bars and they're not going to trade their candy bars, and then there's just 2 candy bars left for sale and 3 kids, that's a better analogy, 2 candy bars left, 3 kids want the candy bars, and they get into a bidding war, the price of those last 2 candy bars is going to go up really fast because you have a bidding war of 3 kids and 1 kid doesn't want to be left out. That based on the rules of the stock market actually determines the value of all the other candy bars. So you got 998 people that are holding their candy bars going, man, my candy bar is worth a lot because of these 3 people fighting over these 2 candy bars, right? So the float's very small. The number of candy bars is very big. It's the same thing with shares. Most of the Reddit shares aren't trading. There's only a few, and there's a sudden influx of demand because of these Reddit readers, right? So, but nonetheless, the price is the price. It triggers the alerts, or the contracts expire. The short sellers are forced to cover. They have to liquidate, or they have to buy back their positions, repay the stock, and eat the loss, right? So that's kind of how it plays out. And, a lot of people are flexing, yeah, we showed Wall Street, but the reality is it's not over. The stock, as I'm saying this, the stock price is still very artificially high, probably 30 to 50 times higher than it should be based on the underlying value of the company. So it's fair to ask, what will happen now? I am producing this video as of January 29th. It is currently where I live, Mountain Standard Time, almost 1 o'clock in the afternoon on January 29th. And this is, you can see a chart here of the stock price just for this month. You can see the spike. You can see that in the last 8 days. And you can see that it kind of started a couple weeks before that. But really in the last 8 days, you've had this dramatic hockey stick formation that's not based on any real value. It's just based on what was happening on Reddit. And so you look at underneath this graph, I basically have who owns the stock, right? So for, let's say, the first 3 weeks of January, it's mostly normal investors. This could be institutions, this could be retail investors, maybe some hobbyists, whatever, and they own the stock for what you would consider normal trading reasons. As soon as the Reddit thing starts to happen and really get critical mass, most normal investors are like, they're going to be like, all right, I'm either just going to hold this and kind of let this thing play out, or I'm just going to get out, in which case they're getting out and it's the Redditors that are buying it up. And so for the last week plus, it's really only Redditors that are trading the stock. And I say who owns the stock. I probably should have said who's trading the stock. It's only Redditors that are trading the stock and short sellers that are having to cover. But then as soon as they do that, the stock goes out of the float because nobody else is going to invest in it while all this craziness is happening, right? And admittedly, during that time, Wall Street loses billions of dollars while the Redditors are all, shuffling the stock around. So let's assume that we're at the top. Can we know for sure that we're at the top? I think today it actually went over 400. Now it's back down to like 300. Who knows? It's super volatile right now. But the reality is it's only the Reddit-driven activist people that are really even trading the stock right now. That's an artificial microeconomy that doesn't have the money or the staying power or the incentive to keep playing this game longer than it takes to make their point. And ultimately, again, it's supply and demand. Once the demand goes away and everybody's not going, okay, let me put my money into this to help make this political point or economic point, sociological point, whatever kind of point it is. Once that kind of expires, there's not going to be any demand for the stock, certainly not at this price, and the price is going to fall, right? But it's still only going to be Redditors that are trading the stock for the most part, right? Because normal investors, we're like, hell no, I'm staying out of this. So during that time, all the quote value, which is artificial paper value that's been created through the increased price of the stock, it all has to be unwound. Every dollar that was made is going to now have to be lost as the stock price returns to its proper value, right? And given that it's only Redditors that bought into the stock during this upswing, it's going to be only Redditors that lose the money on the downswing. Now, you notice I put Redditors lose millions, not billions. I don't know how much Redditors are going to lose because they bought in for the most part with $1 for $1. Whereas Wall Street, like I said, because of this leverage principle, they can trade $1 for $2, $1 for $5, whatever, depending on how they buy the stock. And what exactly they're betting on. Sometimes you're betting on the price of a stock. Sometimes you're betting on the trajectory of the stock. Sometimes you're betting on the momentum of a stock. Sometimes you're betting on the acceleration of a stock. There's different variables that they can play with on Wall Street. But the retail investor is just betting on the price, right? With a dollar in, dollar out, maybe a dollar in, two out if they're on margin or something. Which even that's I don't even think Robinhood supports margin. Like most of the people doing this have no leverage. They're just, dollar for dollar, right? So however much they lose, the point is they're going to lose all the money that they put in during the run up. And it's only the Redditors, nobody else, right? But there are other players here. And yeah, Wall Street lost 20 billion, but they got $1 trillion more where that came from. And knowing that this bubble is going to burst because it was driven by an artificial economy of unsophisticated, populist, activist investors playing to some degree with fire that they don't understand or appreciate, what are they going to do? They're going to short the stock again because they know it's going to crash. And when that happens, they'll make their billions back. Probably and then some. Because now, before they were betting on economic forces to devalue the stock over time, now they're simply betting on a bubble to burst that's a bubble that it has to burst. It's unsustainable. So it's like a sure thing. So they go short the stock now and they can do it with more leverage and it's going to fall further and it's going to fall faster than it did before. And they're probably going to make even more money than they lost. Now, will it be some different people? Did a hedge fund went out of business and maybe 100 people got sent home and they have to go get a day job? Yeah, but in the grand scheme, the institutions are going to easily recoup whatever they lost, probably, and then some. Meanwhile, the Redditors, some of them made money on the way up, but in total, they're going to lose an equal amount of money on the way down. And there's going to be some of them that all they did was buy at the wrong time and lose the money, right? So in the end, some people on Wall Street lost money. Others on Wall Street will make back the money, likely more, depending on how they engineer the investments. Overall, Wall Street is unaffected. Some Redditors made money on the way up. Other Redditors lost the same money on the way down. And the net effect is Wall Street survives with a few maybe personnel swaps. A few rich people might have to go get other jobs, which they're qualified for because they're well educated. They have experience doing very sophisticated things. Like they're gonna land somewhere. They're not gonna be greeting you at Walmart. But some Redditors, they made money, but only at the expense of other Redditors who are gonna end up losing money. And this group of people can much less afford, both individually and as a collective, to stomach and survive these losses, right? Here's why in the grand scheme, I think this outcome was inevitable, because ultimately we have a relatively functional free market. Listen, I know there's things to criticize. Here's why this outcome was inevitable, right? I'm probably gonna get some hate for this, but I'm certainly not trying to agitate it or pick fights. These are just as much as I can give what I think are the facts. The reality is the capital markets provide needed capital and liquidity to businesses to grow. That's just a fact. Businesses need to be able to raise capital from the public, and the public benefits from this. 401ks, retirement funds, even our insurance companies. If insurance companies couldn't invest in these, distribute capital through the markets, then our insurance premiums would be higher. Like there's a lot of benefits to this that affect all of us in a positive way. This creates the prosperity and jobs that most Redditors, and this was a little tongue in cheek, but most Redditors' parents relied on to raise them. Like, there's a generation of people that may not love this stuff, but the reality is your college degree and the country you live in that essentially created the idea of real democratic principles and pushed them throughout a huge chunk of the world. This is all based on, and certainly like the fact that your parents aren't living under a bridge and maybe they were able to quit working and retire comfortably. Like it's mostly based on the economic foundation that's driven in large part by the capital markets. Again, I have to bite my tongue. So that's all I'll say. But as we said, the markets themselves are not driven in the short term by underlying value. They're driven by fear and greed. But what happened here is that a populist fear of capitalism, generally in a context of ignorance about why and how it actually works, I'm missing a parentheses, forgive me, was weaponized via Reddit to defeat the greed of Wall Street. But that's literally the pot turning black to call the kettle black, I would argue. And in the end, it doesn't work because Wall Street has more reserves and more sophisticated leverage instruments to win back more than it lost. And the analogy I'll give here is like, there's a saying in roulette that you can lose and double your bet, right? Or blackjack or any game that theoretically, if you lose and double your bet, then the next hand you'll win back 1 unit greater than the total that you've lost, right? You lose 1, you bet 2. You lose 2, now you've lost 2 plus 1, which is 3, but then you bet 4. You lose 4, now you've lost 1 plus 2 plus 4, which is 7, but if you win, you get 8, right? And so you're always winning back 1 more than the total of what you've lost in any scenario where you can roughly create 50-50 odds. But the reality is in that scenario, over time, the house will always win because they just have more money than you. And eventually, you're going to have lost 9 times in a row and you're going to double your bet for the 10th time and you're going to lose again and you're just going to be out of bankroll. And the house, they're good, right? They'll keep paying you out as many times to get you to re-up again and again and again because eventually they're going to win because they have more reserves. Wall Street's the same way. And also, you've put Wall Street now in a situation where you have an asset that's artificially inflated. It's way overvalued. Everybody knows it's going to collapse and they have leverage instruments that they can use to capture that benefit by a multiple that the retail investor can't. Wall Street's going to win. It's just what's going to happen. And the sad part of this is the last Redditor, aka the greater fool, if you know the greater fool theory that correlates to economic bubbles, gets left holding what's now basically a worthless bag. There are people who participated in this on Reddit who are going to lose a lot of money. And they probably couldn't afford it. The Wall Street in general, the Wall Street guys could. So I hope that the media allows this message to get through. There are certainly needs for reform of capitalism, but we got to do it through the legitimate means that are actually created and protected by capitalism. Capitalism pays for the protection of the legitimate means for reforming capitalism. This populist stuff, it has a price tag, and we're going to see that. Here's what's important to me here, right? Like I actually think over time, as long as we still operate from a principle of free markets, the markets it'll correct as needed and it'll wash all this stuff out. The key value principle here, the key takeaway for me is a value principle, is that value is what the world needs and what capitalism is wired to reward. This is why I teach entrepreneurship. This is why we created Entre Institute. This is why we believe what we believe. If people want to better their situation, they need to not focus on working harder. They need to focus on creating more value. Value means a lot of things. It shows up a lot of different ways. It has a lot to do with a lot of different factors, right? But the fact is, if you want to get more in this world, you have to create more value. Capitalism is a structure that fundamentally says, let's reward value. Everything else is a structure that fundamentally says, let's prioritize something else instead of value. That's why they don't work over time. The problem here is none of this was based on value. That's why the whole thing was destined to fail. So let's actually revisit all the players in this through the lens of value. Remember, we started by listing the players. Let's look at them again. The Wall Street short sellers, hate them all you want, but the reality is Wall Street traders and these capital pools provide the fuel for the economy to grow. They will win over time because there is value in providing the fuel for the economy to grow. And it'll always be rewarded, at least in a free market, right? The Redditors provided no real value to the economy. They did not produce anything. They did not manufacture anything. They did not optimize anything. They did not distribute anything. So thus, long term, there's, in aggregate, there's not going to be any reward because there was no real value created. GameStop is still a shaky retail company that will return to its previous levels because the intrinsic value didn't change, right? They're still dealing with a pandemic and they're still losing market share to online game streaming, right? Robinhood, it got some PR out of this, but no savvy investor is going to go switch their trading to Robinhood. I'm certainly not. It's a tool that was used in this case to create a false microeconomy that drove a bubble that ultimately the only people that gained in the bubble are the same people that are going to lose when the bubble bursts. It's generally considered to be a subpar trading tool. Serious investors don't use it because it has a poor user experience. It doesn't have, There's features called level 2, which gets you more visibility on the actual trading patterns on the floors of the exchanges and get you better access to have your orders filled at your limit prices and whatever, all this stuff. Robinhood's just, you're kind of the last man on the totem pole if you're using that app to trade. And the research tools are pretty poor. So, Robinhood's going to get some exposure, probably a bunch of downloads, but the serious investors that drive value in a trading platform, they're still not going to want to use it. And then you have the market regulators and the power players. They provide a ton of long-term value because they maintain a stable environment for business to operate in. Again, the business that paid for our parents' retirements, and if you're younger than me, our educations were paid for by the fruits of a stable operating environment for the businesses that employed our parents or employ us. And the regulators provide value by preserving that environment so that we don't all get thrust into chaos. If you remove the market controls, you destabilize the economy, you reduce business investment and growth. I know, for example, my business, we spend, a couple $1 million a month at our current scale to operate. And as we grow, that number's only going to grow. And if the markets were destabilized, we would stop spending. We would stop, there's a lot of businesses and a lot of employees that live and grow off of the money that we spend, and we would stop spending, and then they would all suffer, right? And that's just one tiny example of how everybody thinks in a destabilized environment. We would cost jobs, even us. We might have to lay people off, right? The people we kept, we would have to pay them less. The government would make less tax revenue. It would actually hurt the lower classes the most. And I put there, think genocidal outcomes. I mean, we're seeing this with the pandemic. Again, I'm not going to get political, but the reality is when people get laid off, when businesses shut down, when chaos and fear get introduced into the market, at a global level, depression goes up, poverty goes up, homelessness goes up, hunger goes up, domestic violence goes up, suicide goes up, homicide goes up. That's just what happens, right? Millions and millions of people would be at risk if the markets were destabilized and these regulators and these power players, fundamentally provide that stability, right? That's what happened. That's kind of my best attempt to explain this whole situation. The reality is free markets tend to work pretty well. And the guiding principle of all free markets is that they are free markets, and all abuses of that principle, meaning manipulations under false pretenses with hidden or shielded information, things that are abusive to people on the other end of the transaction because of what that they don't, those should always be curbed, regardless of the perpetrator. I don't care if you're rich or poor, if you're an institution or you're an individual. I don't care if you're a professional or an amateur. The free markets should be kept as free as possible. Value should always be the focus. And this is a whole situation, around a lot of, cloak and dagger nonsense where no value was created. If anything, some value was destroyed. At the grand scheme, none of the people that they were trying to hurt got hurt, but some of the people that were trying to hurt the people actually ended up getting hurt. And probably a lot of them were kind of innocent bystanders who just got caught up in the fray and didn't really know what the heck was happening. So yeah, that's my 2 cents. Thoughts, questions, comments? I would love to hear people's feedback. I am totally open to being challenged. I am totally open to, I will delete it if it's just abusive and profane and unproductive, but I'm trying to create healthy dialogue around this. I don't think the media does a good job of creating healthy dialogue around these things. I'm grateful that a platform exists where somebody like me can get their voice out there, and I'm totally interested in what people have to say about all this. Thanks for your time. I'll look forward to conversing further in the comments. Take care.